What's up everyone, it's Scotty with Money Investing. Welcome on board for another Market Open live stream here. We are ready. We've got the big CPI numbers coming out in about 31 minutes. So if you guys can hear me and see me, if the audio and the video is working well, just give me a thumbs up and we should be ready to go. We should be all set. So yeah, just give me a thumbs up. I just want to make sure the audio and the video is well. The markets right now are pushing higher, so we do have the QQQ up a little bit over 77 basis points. We've got the SPY up a little bit over 1%, and the Dow Jones also pushing up over 1%. Right now with the yields, the 10-year yields rotating back down, so they are sitting at just under 3.9% right now. So make sure that you do also vote, because we have a poll going on, and whether that's the CPI number going to be bear case, base case, optimistic, or bull case for today. So again, I'm super excited. The markets are going to be very excited. We are going to see live reaction from the panelists over at CNBC, and of course we'll take a live look at the markets as well. Looks like there's already some volatility, and we're now under 30 minutes from the United States CPI numbers. So we'll take a look at some of the important data and some very interesting charts that I've kind of compiled for all of us. So we'll take a look. And Eunice says red t-shirt. Really? Yeah, I was hoping nobody would pick up on that, but this is yeah, just reverse psychology a little bit. Eunice, like we'll just we'll wear that, and hopefully the markets will go higher. So we'll see. But again, hope you guys are doing great. Thanks so much for joining in, and we'll get right into it. So this is really what goes into the consumer price index. So one of our members, again, shout out to them for kind of sharing this. I've actually done this in a more spreadsheet basis, but this is a very, very good visualization of what CPI is made up of. And you'll notice that energy is about 8%, food is about 14%, shelter, which is rents, are over 33%. So that's about a third of inflation is in shelter, right? Shelter prices, again, are going to be a big wild card, because if shelter prices are good, if they actually see shelter prices coming down, if rents are going down, that in itself is going to be a big lift for inflation. But of course, if shelter prices go higher, well, even if energy and food help us in coming down, that's not going to be enough. Of course, we got transportation commodities, we got transportation services, we got education and communication services, we got medical care, household furnishing, apparel, other recreation services, and of course, some of the more smaller items like recreation commodities. We got water, sewer, trash, so utilities, we got household operations, alcoholic beverages, medical care commodities, and other personal care services. So this is, pretty much inflation in a more visual way, and that's pretty much what it makes up. So, so, all right, a question here. Mortgage rates are now at 7%. Shelter prices coming down? No, not necessarily. Shelter prices is not the same as home prices, right? Shelter is rents. So if mortgage rates are going higher, 6, 7, 8%, the affordability for homes are actually going down. So there's fewer and fewer people that can actually afford homes. So what are they going to do instead of buying? They're going to rent, right? So as there's a more demand towards rent, in theory, the idea would be that rents will start going higher because people can't afford to buy homes, so they will start renting. So that is obviously not great. But again, we'll keep a close eye on how this continues to kind of progress. Last month, we actually saw an increase of 0.7% for shelter. If you annualize that number, so 0.7 times 12, that's an 8.4% increase for rents, right? So, and it's a 33% of inflation, so that's a pretty big deal. That's exactly why we're paying really close attention to overall shelter, and of course, we got rent. So talking a little bit about consensus, this is going to be what the consensus is going to be. So month over month, we've got 0.2% increase for CPI. Year over year, the market's expecting 8.1%, and ex food and energy, which is core, the market's expecting 0.4%, and ex food and energy on a year over year basis, a core CPI, we've got a 6.5% for CPI right now. So moving forward, again, this is a really interesting chart because this basically shows us the potential path for CPI based on different month over month changes. So what this shows us is, okay, for CPI to be under 8% year over year for this print, for the September print, right? Because we're in October, this is a lagging indicator, so we're going to get the September numbers. For year over year CPI to be under 8%, month over month, we need to see either a flat month, pretty much 0.0%, or we need to see deflation. We need to see prices coming down. So that's going to be negative 0.1%. And that is when the September print is going to be under 8%. If we see month over month 0.1%, 0.2, 0.3, 0.4, this is what's the path looking like for headline year-over-year CPI, right? We're going to be 8%, 8.2, 8.3, 8.4 if we see an increase of 0.1%, 0.2, 0.3, 0.4 respectively. But you'll notice that in most situations, in most scenarios, unless of course we increase 0.5 or higher every single month for the next several months, in every scenario, we do expect inflation to rotate back down, especially in the middle of next year, right? So you'll notice that April, May, June, July, 2023, we're expecting inflation to rotate back down to 4 to 5%. So really, it's a 2023 game plan for the Fed to really start to be restrictive here, front load the rates, and then eventually start pivoting a little bit, start pausing interest rate hikes, which is also what they mentioned in their FOMC minutes from yesterday. So that's pretty much the bottom line. And again, we'll pay a close attention to this as well, what that month over month change is going to look like, and of course, how that translates to year over year. And this right here is going to be that Fed funds rate, where we're expected to sit somewhere around 4.4, 4.5% by the end of this year. And of course, going into as much as 4.6, 4.7, and then starting to kind of pause and then start to pivot a little bit as well. So this is, again, very, very important spreadsheet. This is very important sort of visual representation of where CPI really is and what those changes, month over month changes, can do to the year over year as well. So again, this right here is the contribution. So again, if you kind of go back, and this is what makes up the CPI, right? 33% is shelter and rent, then 14% is food, 7.5% or almost 8% is energy. This is what CPI. This is the top line contributors of a CPI. Okay, this is what makes up the CPI. And this is what's been causing the CPI, like causing inflation. And you'll notice that the rents have really been a big component more recently. That's the dark blue all the way down below. This is something that I shared in my yesterday's market live stream as well. And you'll notice how it's been consistently going higher, meaning that it's making a bigger and bigger contribution to top line headline CPI. And some of the other things, such as energy, I think is going to be in orange. So yep, energy is going to be in orange, and then food is going to be in yellow, and the light blue is going to be commodities. So all of them have actually been making less of a contribution to overall headline CPI, but it's mostly been shelter. Shelter is 3.5% of the overall CPI number now. So that's a pretty significant contribution. And again, this is just another same chart in a different sort of format. And this right here is actually going to be back in 1970s, right? So this was a very interesting Twitter post that was shared with one of the people there. And then, of course, what they talked about is when inflation pretty much peaked back in 1974, at the end of 1974, and then it started to kind of rotate back down. And that's also when S&P 500 pretty much hit a bottom, and then we started to kind of see that trend once again move in the opposite direction as headline inflation was coming down, or United States CPI was coming down, and the markets were starting to kind of rotate back higher, and they were pushing up. So Deepak, no, the CPI numbers have not come out yet. For everybody asking, the CPI numbers come out in about 23 minutes. They come out at 8:30 a.m. Eastern. We're just live a little bit earlier because we're too excited. But no, we're just going over some data, just going over some different analysis, different reports, different stuff. And then in 23 minutes at 8:30 a.m. Eastern, we'll be live. I'll actually put up a clock here somewhere very soon. In about 3 minutes, I'll put up a clock that's going to pretty much count down to when the CPI numbers are released in 20 minutes or 8:30 a.m. Eastern. So no, inflation's not come out yet. So this is another thing that was very interesting that was shared. And this is UK CPI from back in the 1970s, right? During the great inflation time of 1970s and 1980s when the inflation was really high. And what this person mentioned is that what's missed is that after the inflation peaks, it lurks in the pipeline that tempts premature easing, right? So what that means is once inflation starts to peak and it starts to come down, what it does is that really puts the Fed in a difficult situation because they don't want to prematurely loosen policy, right? Because it took the UK over 100 months to put the genie back in the bottle, and we will see 4% next year for inflation, but the risks thereafter of 2% or 6% are pretty balanced if the Federal Reserve blinks. I think that's a very good way to put it because we don't want the Fed to prematurely loosen policy. Once inflation starts to rotate back down, we don't want them to immediately start cutting rates again. In other words, the pivot in hopes of, you know, kind of supporting the economy, but then on the other side you get inflation kind of running back up again, right? So it's very, very important that once it's down, it stays down. And that's exactly what they're talking about here, because we did see a little bit of falls, you know, breakdowns here for UK inflation back in the 1970s. It kind of pushed higher once again. Again, this right here pushed higher once again before finally rotating back under 9%, 5% in the future. Yeah, 24.5%. That was a UK CPI back in 1974. So those are some of the updates that I wanted to go over for inflation. This is going to be what my expectations are from a bear case, base case, optimistic, and bull case scenario. So, all right, RM is asking, what do you think it's going to be? Here we are. So this is where we are with my probabilities. So base case is going to be about a 40% chance, and that's going to be pretty much in line with the consensus, 0.2%. Month over month change, we're going to be sitting at 8.1% on a year-over-year basis, 0.4% for core, and year-over-year at 6.5%. And that's going to be a slight increase from the prior number of 6.3%. So the bottom line is that if we actually do hit a base case, the market may not necessarily like that too much, considering that we're once again for core pushing higher from 6.3 to 6.5%. However, the CPI year over year is actually coming down from 8.3 to 8.1%. So again, what you're really seeing in that scenario, can anybody tell me what's going on in that situation? Like, why is headline coming down and core going higher? What is the main reason behind that? What is the main reason why that spread between headline and core is narrowing now? So you know how we talked about our previous report, and you'll notice that before what we had was this spread kind of widening. So it pretty much went from here, so it started to kind of widen quite a bit here, and now it's starting to really narrow in. So now we're starting to see headline come down, but core actually pushing higher. So all right, so yes, oil prices are coming down. That's good. Yes, so crude prices coming down, energy prices coming down, and that's helping the headline to come down, but core is pushing higher because, well, it doesn't include energy and food, but it does include shelter, right? So shelter prices going higher, putting a bigger impact on core. So now we're starting to see that spread kind of narrow in. Once again, earlier it was widening because shelter was not a big part of, or a big contributor to inflation, right? So again, if you come back here, you'll notice that back in 2021, it was mostly energy and food. Like, they were the ones that are actually driving inflation. So headline was pushing higher, core was pushing down. And now it's kind of like the complete flipped, where energy and food are stabilizing, they're coming down, but shelter is what's actually pushing higher. So rents is what's actually driving core once again back to higher levels. So that's going to be the consensus. And I do think that if we do hit a base case, the market's not going to be too happy, considering that core is going to be higher than what the previous number was. And of course, if we do hit a bear case, then forget about it. It's going to be brutal. And even JP Morgan mentioned yesterday, right? We talked about it during our market update, that if year-over-year inflation comes in at 8.3% or higher, well, the market could be down 5% in one single day, right? So that's what they mentioned, that the market, be ready for the markets to be down 5% if inflation comes in 8.3% or higher. So that was a very bold prediction, and again, it's not really surprising, because if we do accelerate again, well, then the Fed has to be more aggressive. They have to be more hawkish, even though they're just, the only thing they're really controlling is demand. They're not really focusing on the supply. Obviously, they can't do anything about the supply anyway, but they're really focused on kind of choking demand by pretty much crippling the overall economy. That's the main goal here for the Fed, is to bring down the overall economy and pretty much disrupt the demand as much as possible. All right, so let's just start our clock here very soon. We'll just get that started, and I'll also, let's see, I'll fast forward it because we are a little bit behind. So 17 minutes, there we go. We should be all set now. All right, so we've got a clock now. By the way, Randy, thank you so much for this. I really appreciate it. I just wanted to thank you. I want to help fund a mic replacement for you. Green lights, please. Yes, that's coming. I promise everybody that is coming, and we will definitely bring up the green mic very soon here. Thank you so much for that donation. So yeah, we've got a clock now, under 17 minutes left for inflation numbers to come through. And again, we talked about the base case, we talked about the bear case. Now the optimistic and bull case, 25% probability. There is a probability for us to for us to see optimistic, for us to see bull case, because energy and food has been down. Again, if you come over to our inflation tracker spreadsheet, you'll notice that metals, materials, energy, and most of food was down, except for wheat, which is up 11.5%, corn up 0.5%, and agriculture fund up over almost 1%. But everything else down, and except for platinum up over 1.7%, and silver also up 5.7%. So for the most part, food, metals, materials, and energy did their part. It all comes down to shelter and rents, and what that's going to look like. So all right, InMode seems to be pushing higher right now. Let's take a look what happened. Is InMode, I don't think they were supposed to report their numbers or anything, but wow, 10% move to the upside here. So this is not because of earnings. But let's see here. This is from July. I'm pretty sure they actually pre-announced their earnings. That's my guess. We don't have anything right now for headlines on InMode, but my guess on a more conservative basis is that they actually pre-announced their earnings, because they pretty much do that every time since I've been following InMode for so long, and we've pretty much traded this stock quite a few times. What they do is, InMode's known for setting the bar really, really low when they actually announce earnings. So what they do is, like, when they actually announce earnings, they'll set the bar really low, but going into earnings, they almost always pre-announce and they beat heavily. This is what happened last time too, when right here, I think it was July 11th, like back in July. So again, July 12th, you'll notice there was a catalyst InMode share surge after Q2 adjusted EPS revenue guidance, right? So again, they pretty much pre-announced these numbers. So my guess is that they also did that today, and that's why the stock is up over 10%. So RM, thank you so much. I really appreciate that. And yeah, we'll definitely give you a shout out when I'm getting my next haircut. So thank you. All right, so how they beat in this economy, people still paying for cosmetic surgery in 8.5% inflation. Yeah, I mean, that's crazy. I mean, I think one of the things that InMode is really going for them is the fact that they're actually based out of Israel. So their cost of production is really, really low, right? So the gross margins are really high for InMode versus for a same company based in the US. Another thing is that InMode actually had a tax holiday for almost 10 years, which is actually coming to an end. So they might see earnings kind of deteriorate a little bit, because they will be having that tax expense in their income statement moving forward. So that is something to pay attention to as well. But yeah, definitely seems like InMode had a very strong beat on earnings. Again, my guess, I'll take a look at what the catalyst was once we kind of get around InMode. But right now, the focus right now has to be on inflation. So, all right, so Carlos says InMode expected to increase 120 million. Just saw the news. Okay, sounds good. But yeah, let's just take a look at the polls. Make sure that you do vote and what your expectations are for the bear case, base case, optimistic, or bull case. So 45% expecting bear case, 20% expecting base case, and then 19% optimistic, 16% bull case. I'll tell you that this is a lot better than when we did this poll earlier, because it was I think it was like over 60% bear versus base, and then I think a lot of people were actually, it was a lot less bull case. Today we're seeing a lot more for optimistic and bull versus bear and base, but today it's a lot better, because we've got more people. I think it's like 30%, over 30%, expecting either optimistic or bull case for inflation. Of course, over 66% expecting base case or bear case. So, by the way, make sure that you drop a like, everybody. Again, we're ready. We're going to do an audio check here in under 10 minutes. And yeah, we should be all set. We should be all ready to go for what the market's going to report here. QQQ is still up almost 1%. We got the SPY up over 1%, and the Dow Jones also pushing up close to 1%, with the 10-year yields sitting at now under 3.9% at the moment. So crude oil sitting at just a little bit over $87 per barrel. And this right here is the complete technicals on the crude oil. So right now we're just sitting at support here. Very, very strong area of demand for crude oil, and resistance all the way up to $90 a barrel. And VIX pretty much down 1.6%. So, oh my God, Dean's really starting to get me, huh? He really wants a reaction out of me by saying that Ronaldo sucks. Nicholas says your red shirt isn't helping the markets. Come on, man, Nicholas. That's all superstition. Nothing really. Markets don't care what T-shirt I wear. Markets don't care what mic I have. Of course, we like to kind of joke around with this, but come on. In reality, nothing. All of this doesn't matter. Um, all right. Let's see. Let's see here. So Oleg says CPI will be 7.9% as majority of Caddy's price data points fall like stone. Yes, that's true. However, again, shelter, Oleg, shelter. Do you have any visibility on shelter? Can you tell me guaranteed how much shelter price? Because I was just talking to one of my members earlier this morning, and they have actually raised rents on all of their properties. I've been talking to my family members, a couple of uncles. They actually own, pretty sizable real estate portfolio. They've been raising rents too, considering that there's higher demand for rentals. So I agree that most of my data points have fallen. Again, this is the inflation tracker spreadsheet. I agree on energy, food, materials, and metals. But shelter, man, rents, is that going to actually fall or not? And again, for us to be under 8%, as Oleg mentioned, 7.9%, we need to see a flat month. We need to see 0.0% month over month, or like a negative number month over month. So if you see minus 0.1% month over month, that would be good. So again, William says I raised my rents as well. So again, you're seeing a lot of people actually do that. So. And it's 30% of inflation. If it was lower, if it was like, let's say 5% or 10% of inflation, really, I mean, we wouldn't have paid as much attention. But since it's over a third of inflation is shelter prices, well, it's a pretty big driver of overall CPI. All right, so we got less than 10 minutes. I'm just going to do an audio check. So again, let me know if you guys can hear this. Just want to make sure that it's working well. And we'd be all set.
Up close and all in.
Can I just say, I love John Mack. He's always been such a gentleman, so considerate and kind and thoughtful, even while he was doing one of these Titans of the World jobs. I admire him greatly for saying what he said about going after this. There's no reason to be embarrassed about this any more than there is a broken arm or anything else that you might have.
All right, perfect. We are all set. It's much better actually not having that microphone because I'm just like always switching in between. Since I'm using just the MacBook's microphone, it's a lot better. It's just one click of a button, I can switch in between. So, Ray says, I'm scared, Caddy, hold our hands. Here, take my hand, right here. Yeah, Erwin says, just connected and we have a countdown. Of course we do, come on, we take things really seriously. So, it's gonna be interesting, right? We'll kind of break down the entire report again. This is where the data is going to be released. If you are interested in kind of taking a look at yourself, it's going to be bls.gov. So you just simply go to that government website, you go to subjects, you go to consumer price index, and this is where data is scheduled to be released. September 22 CPI released on October 13th at 8:30 a.m. Eastern. It's in about 8 minutes. And then, of course, we can take a look at the charts as well. This is actually very interactive, so you can go over to the 12-month percentage point changes, and this is where inflation is, right? So you'll notice that we are actually coming down a little bit from 9.1% back in June. We came down to 8.5, now 8.3, so headlines coming down, but core is obviously not stopping at all. So this is going to be core. Pretty much went from 5.9 to 6.3. So we were pretty much 6.5 was the peak back in March for core. Came down a little bit and now we're pushing back higher. It kind of seems like a very similar dip to what we got over here, like back in May and June of 21, where core pretty much went from 4.5 down to 4%, and then we just blasted through 6% in the next couple of months. It kind of feels like very similar to that trend where we're just seeing a little bit of a pullback. It isn't an uptrend where we're seeing a bit of a pullback before it kind of blasts through above. Hopefully not, but just 6.5%, 7% is going to be that peak for core. So M&A, how is inflation fixing market expecting inflation? So they actually expected inflation to peak out in October. So that's a report that we actually broke down, I think a couple months ago, where inflation fixings were expecting for inflation to peak in October. We are in October, but again, that October report is going to come out in November. So this is a lagging indicator again. So we're going to have to wait another month for hopefully for us to see whether inflation has indeed peaked or not. I mean, of course, on a headline basis, on a year-over-year basis for headline, we're still coming down, and core is also nowhere near close to its March number. But again, the question really is, are we trending down, or are we still in that pullback phase where we start to kind of push higher once again? So that is the real question, because as I've mentioned before, one data point does not make a trend. We need to see like series of data in order for us to actually figure out, okay, we're actually trending down for inflation. One data point can be great. We can see a big shift down, but it needs to actually kind of show us some really good improvement over the next several months. So Gabriel says supply chain disruption still taking a toll. Yeah, 6 minutes, under 6 minutes is where we are. And inflation obviously is going to affect interest rates. Interest rate expectations for the Fed funds futures are going to be affected as well. So right now we're sitting at 86%, even though in my opinion, it really should not matter, because for 2022, we're pretty much set in stone. I really strongly believe that 75 basis points is a done deal for November, and then another 50 basis points should be done for December. But of course, the market likes to anticipate. The market likes to forecast when that quote-unquote pivot's going to happen, because if and when we get that pivot, that's obviously going to lead to a significant rally for the market. So right now, 86% probability. And again, we'll keep a close eye on how this changes, because it will most certainly change after the inflation numbers come out. Again, we'll just keep a close eye on that. So, all right, we are ready. We're going to keep a close eye on, well, this is going to be the Nasdaq. I'm going to put the SPY over here. I'll put the dollar index up here. And then, of course, the 10-year yields over here as well. And then we should be all set. We will bring up the actual CPI numbers here. 4 minutes. 4 minutes left to go. They're talking a little bit about the gills on here. Yields down, stocks rally here. Again, it really depends on what the pension funds are doing. They certainly need to rebalance before the 14th in order to not basically collapse. So it's literally just like, do or die situation for pension funds and of course the banks over in the UK. So why is your video title already saying inflation? What do you mean, Roderick? It says huge inflation print, right? So Trucking Forever, good morning, good morning. 3 minutes left. And yeah, well, we're all set. We're going to actually switch over to this as well. I'm going to put that over there. So we'll just kind of reload. So first thing we're going to do right at 8:30 is just kind of reload this page to see what the inflation numbers are, like what CPI all items is going to be, so I have a really good sense to what happened. So again, last month, shelter and food was higher, gasoline was lower, energy prices were lower. This month, I'm expecting at least energy and food to be lower, but shelter is a wild card, so we don't have any visibility on that. So, all right, who's ready? Who is ready here? Make your predictions. Make your predictions in the comment section down below, and let us know what you're expecting for year-over-year inflation in about a couple minutes here. We got 2 more minutes left. Oh, like 7.8%. Man, for 7.8, we'd have to go down month over month, 0.2%. There has to be significant deflation in order for us to see year-over-year 7.8%. All right, 8.1, 7.9 to 8, 8, 8.2. All right, so minute 30. we'll just have this playing in the background, and then of course we'll take a look at the BLS website to get that live report, and then take a look at the market's reaction live in about a minute. 1 minute, 30 seconds left. And again, the 10-year yields are going to be to my bottom left. So right here is going to be the 10-year yield. The dollar index is kind of getting overshadowed by the live stream, but we'll take a look at that after as well. Eight 8.5, 8.3, 8.5, 8.4. 7.9% deflation it is. Markets certainly are pushing through right now. 1.2% for the SPY. QQQ is up 1.27% as well. All right. Let's see if you have any. All right, I'm just going to reload this page.
All right, welcome back, everybody. We are just a few seconds away from that September CPI number. The last time this happened, it was not good news. It was a hotter than expected number. And since then, we have lost $36 trillion. Or $4.7 trillion that's come out of the U.S. market, down 12.1% on the S&P 500 since that time. This time, we're expecting a number month over month up 0.3%, year over year up 8.1%. Let's get right over to Rick Santelli. Rick?
All right, well, let's start out with CPI for the month of September, up 0.4 on headline, double the expectations, and that is the highest since, well, June, when it was at its peak at 1.3. That was the highest since 2005. If you strip out the all-important food and energy, also 0.2 hotter, up 0.6. That's the hottest since June, when it was up 0.7, high water mark all the way back in April of 21 at up 0.9. Year-over-year numbers, 8.2, hotter than expected, but cooler than the rear view mirror. 8.2. Until we get a revision, it follows 8.3. The high watermark here was 9.1. That was in June, going back 4 decades. And finally, year over year, strip out food and energy, also hotter than expectations, up 6.6. That follows 6.3, and 6.6 is a new high. The old high was 6.5 in March. That went back to 1982, but in 1982 we went all the way up to 9.3. So even though it's a new high watermark, it doesn't change the comp back 4 decades to 1982. If you look at yields, they are just skyrocketing. We're almost back up to 4% in 10s. Now let's go to initial jobless claims. 228,000. That is up 9,000 until we get a revision to the 219,000. And on continuing claims, 1,368,000. Darn close to expectations. Very close also to the rear view mirror, 1,361,000. But we can really see the yields have shot up here to 4%. And if you look at what's going on with regard to 2-year note yields, they're all the way back up to 4.32. So this is a hot number. And with the expansion on that 6.6 on the core, and we all know it's about food and energy, this is definitely going to pique the ears of our central bankers domestically and globally. It's going to make the dollar index much hotter, and it may also complicate some derivatives that you were talking about earlier. I used to run a derivatives products group. There's 2 things you can't control. What we call discontinuous volatility. When gilt prices and yields get crazy, you can't make your periodic adjustments that you need to make. And option volatility. There's no way to compensate for gap jumps and option volatility. If your models are replicated.
Yeah, so dollar index, look at that, up over 35 basis points, all in just under 1 minute, with the yields pushing up to 4%, and of course the market's absolutely tanked. What I first saw was this number right here, 0.4% on a month-over-month basis. This is a pretty big deal, because if you come over to what we were looking at, 0.4%, this is like the hottest print, right, that we could have pretty much expected for. And year over year, of course, we're now sitting at a little bit over 8.2%, and core going up to 6.6% is not good. I mean, if you come over to charts here, And again, if you come over, we were literally just talking about less than 5 minutes ago. We were talking about core and whether this is going to be a short-term pullback or if we're actually trending lower. And this, we just kind of blasted through our peak from back in March. So we just got up to 6.6%. We just literally just hit a new high on core CPI at 6.6%. That's a pretty big deal. Shelter prices, again, does anybody want to guess how much shelter prices were up on a month-over-month basis? Take a guess. Take a guess how much shelter was up. 0.7%. Again, that's annualized 8.4%. 8.4%. So energy was down. Again, looking at our inflation tracker spreadsheet, energy was down. Food inflation was slightly higher, 0.8%, 0.7%, and of course shelter, 0.7%. Yeah, that's a pretty big deal. Apparel prices are lower, new vehicles, used cars and trucks, all of them are down. But shelter pushing up 0.7%, and again, analyzed, that's over 8.4%. And year over year, all items less food and energy, 6.6%. Headline sitting at 8.2%. So if you come over to our spreadsheet, so okay, we were 0.4% for this, 0.4%. We were at 8.2% for this. Core year over year is now 6.6%. And core month over month went up how much? Let me take a look. Core month over month pretty much went up here. 0.4%, I think. 0.6%. Oof. 0.6%. 0.6%. So if you look at what we got against the consensus, right? Consensus 0.2, actual 0.4. Bear case, right? Hits our bear case there. CPI year over year. Consensus 8.1. We get 8.2. Bear case. Anything over 8.1%, we knew it was going to be bear case. Then you come over to core month over month. The consensus 0.4%, we got 0.6%, right? So again, bear case. And then core year over year, 6.5% was the consensus. We came in at 6.6%. Literally, this is the same print from last month. On all four accounts, it's hit bear case on all four accounts. This is the actual number right here, and everything just hit the bear case. And therefore, the markets are just pretty much how they are, with the Nasdaq dropping 2.5% in literally a matter of 5 minutes. There we go. Just again, another reality check, right? In shelter, interest rates, shelter, of course, rental is what's really driving overall inflation. Of course, energy prices are rolling over, but it's food and shelter. That's what's really putting a lot of pressure on overall inflation. And if you take a look at some of the individual stocks as well, man, I can't even imagine where everything's trading at right now. Tesla, people are saying at 210. So Apple's down to 134, Nvidia's down to 110, Tesla's down to 210, down almost 3%, and AMD down to $54, down a little bit over 3.4%. Let's take a look at our Fed funds futures. Let's see how they're doing. Any guesses before we reload this page? I'm guessing at least over 90%. At least over 90% of Fed funds futures has to be priced in for 75. We're 84. This is going to take a couple minutes to readjust. It always does. Give it 15 minutes, 10, 15 minutes for this to be readjusted for the Fed funds futures. But my guess is at least over 90% probability for us to see a 75 basis points. And it should be that way. It really should be that way. But yeah, there we go. That's the overall print on inflation. If you go over to some individual items, which I really like to do, let's see what was actually driving higher. So again, energy was lower, -5%, -10, -5.9, -10.5, -10.6. If you take a look at how much it was lower, it was exactly how much our inflation tracking spreadsheet had. 10.2% for crude oil, right? 10.27%, and gasoline 5.06%. And if you take a look at this, again, 10.5, 5.9, so almost pretty much down is what we were expecting. But shelter rents 0.7%, and owner's equivalent rent of residence is 0.7% as well. Stefan says, please, Caddy, take off your t-shirt. Guys, it has nothing to do with it, but I know what you mean. I know everybody's just joking around, but So food here, 2.2% for bread, white bread pushing up 2.6% month over month, 2.2% for breakfast cereal, 1.2% for fresh biscuits, rolls, and muffin. Then we got 2% increase on fresh sweet rolls, coffee cakes, and donuts, also pushing up month over month. Meats, poultry, fish, 1.4%. And then negative 1.9%, 4.9% Frankfurters. This thing has always been really volatile. It's kind of surprised me how Frankfurters have been so volatile in prices. They go up 16%, they come down 6%, and they go up 5%. It's been all over the place. Then we got apples, bananas coming down. 2.5% increase for potatoes. 3.4% increase for canned fruits. Give the people what they want. It's too late. I would have. Oof. It's too late. I would have definitely switched my T-shirt if it was before the print. It's not gonna help us now. We already got the bear case hit. Like we literally just, if you take a look at our spreadsheet, the actual numbers are pretty much in line with bear case. All of it. You know, it wasn't even one print that we got. Okay, it was somewhat optimistic or somewhat base case. That's why the probability was so high for base case to bear case. You know, 75%. Bull case was just straight out of question, no doubt, 5%. There's no way that's happening. There was some little inclination. I was hinging a little bit, 20% optimistic, but the wild card was shelter there. So that was the overall inflation print, everybody. A complete update on all of it, everything. You pretty much know now everything you need to know about inflation. I think shelter is what's driving prices higher. Food is also somewhat higher. Energy is rolling over. And I think, you know, what Kathy would have talked about, what other people have talked about in terms of apparel and double, triple ordering, like over inventories, I think that does affect apparel prices though. Like it doesn't affect shelter or anything else. And that's already showing. So if you come over to apparel, you know, apparel prices were down 0.1%. So it's starting to show a little bit. This is the first decline month over month for apparel in over 6 months or so, right? This is the first time actually seeing new vehicles, used cars and trucks, apparel, all of them come down on a month over month basis. So those things are showing up, but they're obviously not a big component of inflation. So if you come back to sort of like the breakdown of inflation, apparel is less than 3%, you know, so 2.67%. So even if apparel prices come down because of all these companies double and triple ordered, by the way, you know, went to Nike yesterday, they really do have an inventory problem. Like they really do. That guy that I was talking to at Nike was pretty much saying that we've never seen like discounts. They were pretty much selling 50% discount on all t-shirts and shorts, and shoes were selling for 30 to 40% off. So they pretty much mentioned they've never seen like a discount that high at this store ever. So no doubt, you know, a lot of these apparel companies, they do have a problem when it comes to inventory, the double, triple ordered, but that's not enough. That's really not enough. What needs to happen is, you know, rents and shelter prices, food inflation needs to be more under control. And hopefully, you know, that's another thing. Energy prices are rotating back up. So if you take a look at crude oil, and it's just kind of like adding insult to injury, if you come over to monthly candles on crude, well, in October, crude prices are up 8%. So we got energy prices down for previous month. Why? Because September energy prices were lower. They were down 10%. Well, in October, they're up 8% already. And we're like in the first 12 days in this month. So if energy starts to add even more pressure to the already existing shelter and food, well, it's going to get sticky. It's going to get really sticky for inflation. It's going to become that much harder for the Fed to clamp down on inflation. And the problem really is that they're only controlling demand. They can't control the supply of anything. And that's kind of like the biggest setbacks and drawbacks of monetary policy is pretty much being one-sided and only focusing on demand and choking demand at the cost or at the risk of pretty much crippling the economy. And that's what the Fed wants. They want to pretty much lower economic growth. They want to soften jobs gains. And that's what's happening right now, unfortunately. So let's just see where we are with our Fed funds futures. I'll just reload this once again, see if there's anything's been priced in yet. Wow. So now we're 95%. 95%, 75 basis points, and then 4.6% for full 1%. Yeah, this thing literally just switched. Obviously, it has to. It's supposed to. We were just giving it a couple minutes before it does. So 95% probability. It's pretty much a done deal, And we talked about it literally 5 minutes ago, that this should be over 90%. It was at 86% going into the print, and this should be at over 95%. And here we go, 95% for 75 basis points, and then 4.6% for full 1 percentage point increase. Yeah, I think the 1 percentage point is going to start to become increasingly likely going into the November 2nd meeting, considering what we just got. I think the biggest problem here in this print was core inflation. Core inflation going up is a problem. Is a problem for the Fed, that they need to unclog core inflation, which is going to become really, really difficult. I just want to take a look at the actual individual items here. So if you go over to charts, all right, let's see. So core, we already know, is up 6.6% on a year-over-year basis. That's a pretty big deal, right? Getting up to 6.6%. Let's take a look at shelter. Look at that. Look at this uptrend. Shelter is up 6.6% also on a year-over-year basis. So it's pretty known now at this point that shelter is what's driving core inflation higher. How does the Fed even control shelter prices? Like, how does the Fed even... I'm trying to find that linkage between raising interest rates and somehow lowering shelter prices. Because if they keep raising rates, it has to be positively correlated, no? Because if they keep raising rates, that's going to drive mortgage rates higher. That's going to reduce affordability for people, and what they're going to do is not buy homes, they're going to rent. It's positively correlated. So, yeah, it's a little complicated. I mean, how does the Fed even try to reduce shelter prices, rents? How do they even go about it? Like, it's positively correlated. And that's the thing, right? There's a lot of things the Fed can't control, and they're just trying to fight something which they have little to no control over. It's a very, very difficult situation, especially for the Fed. We've talked about how they don't control supply. They have literally no control over the supply of things. So, van life all the way. But yeah, this is a shelter going up from 2021, 1.5%, all the way up to 6.6. If you take a look at food, that is also kind of leveling off a little bit. So we just got, 3.5% come down to 13.5% come down to 13%. So, that's a pretty significant, pullback, but still look at this rally for food inflation, right? Obviously, a lot of it had to do with Russia's invasion of Ukraine because of supply chain issues. I mean, a lot of the corn, soybean, wheat, a lot of those things that are produced in Ukraine, Russia. And of course, obviously, things didn't help when India is putting a ban on exports of rice and wheat either. So that's what's driving food inflation higher as well. So you got food and shelter. Energy prices, if I come over, let's see. We'll just put gasoline. Look at that. It's been consolidating sideways, and now it's really trending down. So that's good. We're getting that benefit from energy prices rolling over. Natural gas also peaked at 38.4%, more or less stable right now, so not really pushing higher or lower. But new vehicle prices rolling over, so they've been coming down. So that's good. So you can see how from April 22 it's been coming down, and then let's see, medical care services, however, has been pushing higher. So we're seeing a little bit of. And again, that's the thing, right? Services inflation has really been ticking up, and goods inflation really not so much. Goods inflation's been coming down, services inflation's been pushing higher, and that's really what's been the big driver of inflation. There we go. Nasdaq's down 3%. The dollar index with a huge pop up to 133. Yeah, Ranjit Qs are 255 now. Wow. That's pretty crazy, right? I mean, we're implied open 3% lower, so we're gonna probably open at around 10,000. Literally just on the brink of 10,000. Like we're like so close to breaching 10,000 on the Nasdaq. That's where we will end up opening, and then of course intraday very little optimism going into today. So and again, you'll notice the 10-year yields pushing up to 4% now. So we're at 4% for the 10-year yields. 3-year push up to 4.5. 2-year push up to 4.47. And 6 months now at 4.28. So all long dated bonds, even short dated bonds, all of them pushing through quite substantially right away, with the dollar index pushing up. All right, let's see. Let me see if I can answer some questions here. AMD at 55.55. Yeah, definitely been selling off quite a bit. And this is not even pricing in earnings. Can you believe that? Like, this is not even pricing in the earnings revision that we might see in the third quarter, like with the Q4 cuts. So once you price that in, again, you guys know what my worst case target is on the S&P. In an average bear market, we drop about 36%, and my worst case target, if I were to put a number, is 3,000. That's 200 EPS times 15 multiple. That's simply based on mathematical price earnings multiple for the S&P 500. So I think at that point we'll be priced in for somewhat high inflation, and we'll also be priced in for earnings recession, which will pretty much start. I mean, if it weren't for energy, we're already in an earnings recession. We're in both GDP recession and an earnings recession. If it weren't for energy for earnings, and if it weren't for the trade balance for the GDP, like we would pretty much be both of those. And if it weren't for unemployment either, unemployment is really low, which is what most people in the office have been citing, right? Janet Yellen, President Biden, they've been talking about how, oh, the labor market's so strong, the unemployment rate's at 50-year low. There's no way we're in a recession. I mean, it's a pretty significant lagging indicator. Shashang, are you holding cash at the moment? Yes. So I'm about 16-18% cash. I want to get that number up to 20, maybe 25% cash exposure, and really have just not been, dollar cost averaging, really not been buying at all. I mean, it's just, there's a lot of macro headwinds on the big picture stuff. Nothing really has changed for us to, put ourselves in that situation where we can start dollar cost averaging or buying again. Sure, there's individual companies, there's individual stocks that are trading at really, really attractive prices. I mean, I still do think that AMD at 55 is just a steal. But can it go lower? Absolutely. A lot of things are trading on sentiment. So the sentiment's really weak, and can the prices go lower? Absolutely. So if I were to dollar cost average, knowing fully that prices can go lower. The volatility is very subdued. Only down 1% right now. Is that even live? I doubt that's even live right now. So let's see. Yeah, it still shows 33.29. That's kind of strange. Let me know what you guys see on your platforms. Ryan says I'm 95% cash. That's incredible, man. That's awesome. So Chris, does your current fair value of most of your companies change a lot now, or still overall the same? So Chris, great question. The fair values don't necessarily factor in where inflation or interest rates are, because that's more of a macro prediction, which I'm not making. It pretty much depends on where earnings are going to be, right? So if earnings are declining, if there's any changes in the earnings, then my fair values change. If there's no changes in earnings, if the growth is pretty intact, then my fair values remain unchanged, because I'm, again, forecasting for the next 5 years. If I were forecasting for, let's say, 1 year or 2 years, then there might be a component of, let's say, interest rates or inflation that I might try to estimate. But since I'm forecasting for the next 5 years, there's little to no influence of interest rates and inflation, because over the long term, the expectation really is for things to stabilize and kind of average each other out. We're seeing high levels of inflation now. In 3 years or 4 years from now, the expectation is that we see deflation and low levels of inflation, so it kind of averages that out. So pretty much the only time I would change my fair values is when there's a change in earnings. And just like AMD announced, I think it was last week when they cut their guidance, I pretty much switched up my fair value as well, because, well, they're cutting their guidance for the third quarter. They're also potentially going to cut their guidance for Q4. And as a result, we had to lower our fair value just a notch. So Tesla almost at $200. Yeah, it's been getting destroyed, right? $209. Here we go. Getting very, very close. Very close. Where to download the CPI report PDF? So you can actually do that at bls.gov. You can go over to that website. So again, just go over to bls.gov. That's the government website. Go over to subjects, consumer price index, and then you can download this PDF right here. It says HTML, PDF, RSS charts. You can download this PDF and pretty much hit print, and you can literally just download that, save as PDF right here. Yeah, you want to make sure that this is for September though. Sometimes it doesn't reload. So what I do is I open it up on incognito. So there we go. Now we have it for September. So will the Fed go 1.25% on rate hikes in November? Ooh, 1.25 is a little much. I don't think the Fed's going to go that far. I think right now we're just pegged for 75. And just a small probability for us to see 1%. So I think that's going to be more appropriate for the Fed, like 75 basis points or even as much as 1%. But I doubt they're going to do 1.25. Like that's going to be insane. That's going to be a big shock to the overall economy. So on how's the market doing? You tell me. The market's been brutal. Well, after the print, it's just been selling off. So yeah, it's just been selling off. We've got the dollar index, the yields pushing up to over 4% now. So the yields actually just hit their new 52-week low, 52-week high, 52-week high. The yields just hit their new 52-week high. So a pretty substantial number, 4.032%. And again, that's going to push our hurdle rate higher and higher. For those of you who don't know, that if the yields push up, that pushes up the discount rate because the risk premium also gets lowered as yields are going higher. So now when we do our fair value estimates, we're gonna have to apply a much higher discount rate, and that's gonna lower the fair values even more. That's the market we're dealing with. If the 10-year yields were at 2%, I would have been fine using a 12% discount rate, or maybe even a 10% for some companies that offer dividends. But if the 10-year yield is at 4%, then we're gonna have to kind of readjust, right? If you're taking on that additional risk, we want to be compensated for that reward, right? For that risk, we want to get the higher reward. So we're going to do, like, let's say 12%, 14%, in some cases maybe even 16% for the discount rate. Yeah, Keelix says next stop, the UK pension fund bust. Yeah, that's the next stop, right? That's the next thing that we're paying attention to. We kind of switch our gears, come over to investing.com. Let's see how the yields are doing, the gilts, right? So gilts. So we'll just look at markets. You can come over here to the bonds and the world government bonds. You can pretty much come over here, and it pretty much will give you all the government bonds for pretty much every single country. So all the way at the bottom, you'll see the United States and the UK. So the UK gilts are rotating down. So they are down. That's good. We are seeing the 1-year gilt down 8.8%. We're seeing the 30-year down 4.8%. That's good. I mean, yields come down to 4.6%. So that's what we want to see. Yields come down. Additional pressure would be if the yields were higher. That would be more pressure on the pension funds. So far so good. I mean, that's good. We're seeing the gilts kind of rotate back down, at least for now. So that's where we are. Individual stocks also, of course, rolling over. Meta price back to December 19. Actually, December 2018, going into 2019, if I'm not mistaken. It's actually 4-year low for Meta, not from 2019. I think it's 2018. Caddy CPI less than 8.2%, less than 8.3%. Why so much of a reaction, Ranjit? So, great question. Really, I think the bigger reaction was core. So if you take a look at our spreadsheet, which I also shared in our Discord with all of our members, you can see how the actual numbers pretty much hit right on the nail with all the bear case scenarios. The base case, the consensus was 8.1%. You're right. We were lower than 8.3%. We still are. Like, that's the prior number. But the consensus was still 8.1%. And not to mention that month over month, we saw pretty substantial gain on both headline and core. And the one thing that really was like a gut-wrenching number for the market was the 6.6% on core. That was not only above the prior number, it was not only above the consensus or the prior number, it was a new high at 6.6%. So that was the number today. The actual is pretty much in line with the bear case. Man, I don't even get to use my green colors anymore. I create these spreadsheets and I can't even use the optimistic or the bull case green colors here because, or not even the yellow. Like we don't even get the base case. It's 3 months in a row. 3 months in a row where we have gotten just bear case out of the park. Yeah, in mode is the only green in my portfolio. Yeah, in mode with a very good earnings, preliminary earnings is what I'm assuming from the company. So let's see, in mode earnings. All right, right here. So Q3 guidance, that's what they pretty much announced 34 minutes ago. And of course that as a result was up 10%. I don't know how much it's up now, probably a lot lower. Yeah, pretty much been cut in half, only at 5.3% now. Guys, make sure that you drop a like and of course subscribe to the channel. We've got over 1,100 people watching and I doubt all 1,100 are subscribed to the channel. We talk a lot about fundamental analysis, technical analysis, macroeconomics, stocks and options. So you'll get like a wide range of analysis and of course content every single day. So I really appreciate it if you simply subscribe. If you do, of course, enjoy the content, of course, if you do like it. So I really would appreciate it. And we continue to grow our community. We just hit 71,000 subscribers yesterday. So I'm truly grateful and really appreciate all of you. So thank you. Thank you very much for that. David, yes. So Meta definitely been way under our fair value range. That's true. But again, the sentiment is just so weak that we know that it's going to go lower. It can certainly go down to 120s or even lower. Like just like Tesla can certainly come down to low 200s and even 190s. Nvidia can come down to low 100s. So it's really one of those situations where we have to fully understand that, look, macros, nothing's changed. The Fed is still tightening. Fundamentals are getting better and better and better. Stocks are de-risking. Technicals are oversold. But because of those reasons, the sentiment's also really weak, right? Sentiment can drive, we always overshoot, right? We always overshoot on the downside. We always overshoot on the upside. So right now what we're going through is overshooting on the downside. There will be levels where you'll think that, oh my God, these stocks are trading at these levels. Yes, because sentiment does that. We overshoot. So we just have to be really patient. That's all it is. And look for that spread, right? So those are the 11 macroeconomic signals I've talked about. Let me see if I can bring that up for us. So again, if you can actually check out, you can go to the channel and there should be a video where I've actually posted that. Let me see if I can bring that up. So search 11 signals. So right here, 11 signals I'm tracking before I buy. This was 1 month ago. Full list, you can check that out. It's a 19-minute video. And I highly encourage you to kind of pay attention to what we're looking at. Technicals may get hit and we may get some oversold bounces, some technical rallies. Like I think earlier last week is when we saw very significant rallies for the market. At least in like 2 days, I think the Nasdaq and the S&P were up 5% because we were very oversold on a technical basis. But in order to actually start, aggressively dollar cost averaging or starting to heavily buy, there's a lot of things on the macro front that need to kind of shift, right? So let's see if we can actually. So let's see if we can actually figure. Those are the 11 things, right? So. All right, so this is the list, right? So we're looking at inflation, obviously, coming down. That's the first economic signal. We're looking at the Fed funds interest rates versus the CPI for that spread to turn positive, and it's becoming increasingly difficult for that to happen because let's see if we can. I've actually looked at that and CPI. Let's see. Yeah, that's not it. I might have to take a look at that again, but in that video, I actually share that with all of you. So let's see if I can actually go back. No, it's the unemployment rate. There it is. So this is what we're looking at. And what this shows us is the federal funds effective rate with the consumer price index. And right now we're obviously negative, right? This is the 0% line, which is the black line. And we're trading below that because the CPI, which is inflation, is much higher than the Fed funds rate. So if that continues, well, it becomes really difficult for interest rates to put a dent on inflation if inflation rate is running higher than the interest rate. So watching that spread really is a big macroeconomic signal for me, and whether that spread becomes positive in the future or not. And there's two ways that can happen. Either interest rates go up and climb above the CPI, or the CPI comes down and climbs below or drops below the actual interest rates, or they both happen simultaneously. Interest rates go up, inflation comes down, and we have that spread turn positive. But am I watching Caddy's video in a yes, yeah, you're watching me watch my own video and kind of go over that. So a little bit of inception there. Mason, again, just paying attention to the macroeconomic signals, the fundamental signals, a lot of different things that I think are really important for the market. So, Caddy, in case inflation starts dropping and we have a bull market, do you think it will rally same as 2020 bull market, or that was artificially boosted to the market will never repeat that rally? I don't think the market will repeat that rally again. There's only one way the market repeats that rally. Does anybody know what that is? There's only one way. Like, what happened in 2020 for the markets to pretty much rally that much? A couple things happened, right? QE, yeah. Significant quantitative easing. Fed goes to zero. You guys are absolutely right. Fed goes to zero, significant quantitative easing. We get a lot of fiscal stimulus again. And I really hope the authorities, like monetary fiscal policy, have learned what that type of quantitative easing can do to the economy and the market, and what the consequences can be to not repeat it again. You know what I mean? So I really hope that they don't repeat it again in the future. What I think will happen, though, is if and when inflation starts to rotate back down. So again, this is very, very important for us to look at. This is pretty much the math behind what inflation numbers might look like in the future. Once inflation starts rotating back down, I really, really hope the Federal Reserve takes a more controlled and more balanced approach of lowering interest rates. They don't lower them all the way down to 0% because, look, we're going to be in recession. Unemployment's going to be higher. So a lot of people are going to be asking the Fed to lower rates. They're like, I mean, Kathy Woods pretty much issued an open letter for them to lower rates. So there will be a lot of need for the Fed to lower rates, but I really hope that they don't do that right away. They do it in a more controlled and a more balanced way, that they lower it by 25 basis points every so often, in order to make sure that inflation doesn't get back higher, so it's controlled, and while also supporting the economy in a more balanced way. 2020 was kind of like, look, we're going to drop all the way down to 0%. We're going to print all this money, give all this fiscal stimulus to people, and boom. The economy grows, the market grows, and now we're kind of dealing with the after effects of all of that, right? High inflation, high interest rates. It's just kind of like the opposite of all 2020 and 2021 was. So, Caddy, big question for you. When will Caddy be ready to go all in? I think at 3,000. S&P 3,000 would be a level where I would be very much heavily dollar cost averaging. And of course, a lot of things depend at that time. Like, hopefully we don't have inflation accelerating in that environment. If and when S&P, gets down to, let's say, 3,000, I really hope that inflation is not like at 10, 12, 15%, because, well, that's just going to create a bigger problem for the markets and the economy later down the road. So if inflation's under control and it's coming down, and interest rates are normalized 3,000 I think is a very attractive level for the S&P. 36% down, that's kind of in line with the average bear market. And valuation would be really low. I mean, we'll be trading at 15 times earnings on 2022 based on $200 EPS. If you kind of put forward, like, let's say $3,000, 3,000 divided by 226, we'd be trading at 13 times earnings. If the 226 remains intact, again, if you come over to our fair value, so let's see, S&P 500 PE. So this is the one that we've been kind of tracking, right? So that's 224 is the actual 2022 number, and $242. By the way, this spreadsheet again is available for everyone, so make sure that you do check that out if you haven't already. It pretty much goes over the last 40 years worth of EPS for the S&P 500, the changes. It goes over the price, the S&P 500 price, like where it was trading, the trailing price earnings multiple, and of course it also goes over what 2022 and 2023 might look like in terms of that earnings per share and the current valuation. This gives you a little bit of a bird's eye view of where the S&P 500 is trading at. And at 3,000, we'd be looking at 13 times earnings, 12.5 times on a forward basis, considering that these earnings per share levels hold up. Of course, if they come down, if we're looking at, let's say, 225 and 200, well, then at 3,000, we're still at 15 times price earnings multiple and 13 times on a forward basis, which is still not bad. I mean, 13, 14, 15 times earnings is really cheap. Much lower than, all of this average, like 32 average, 25-year average, 15-year average, all those things. So Matt, can you see it going less than 3,000? Well, it really, that would depend very much on whether we see like a really brutal recession or like a depression in the US. For the markets, for the S&P to be down over 40% from all-time highs would very much depend on the state of the economy. Very much. I don't think the sentiment gets us down there, but sub 3,000, like a 37-40% decline, we will be overshooting on the downside, no doubt. Like, we'll definitely be overshooting on the downside, but it also depends on the severity of that recession that we're in. So, change, the way change happens is not fast. Change happens slowly, and then it all happens very fast. I think that's what's happening with unemployment. I think we're not seeing any significant shift in unemployment. It's happening kind of brewing underneath. It's happening slowly, and then just a couple prints, man, we'll be like over 5-6%, in my opinion, I think in 2023. So I think that's what's happening with unemployment. It's like happening slowly, and then all of a sudden just like rockets higher. So why is InMode higher? So InMode pretty much reported their earnings, preliminary earnings, and their guidance. So they did really well on that front, and that's why they're pushing higher. Simple Person says, you explained quite well. Subscribed you. It's very informative. Thank you for sharing all this info. I appreciate it. Thank you. I really appreciate it. So SJM8, unemployment rate will not go down. Yes, that's what I mentioned. Like, it will not go down. It will go higher. Like, it's right now it's pretty steady at 3.5%, but what we're really saying is that it's gonna go higher as interest rates are going higher. So I think you and I are on the same page. Denny says, people laughed at me when I said QQQ was going to low 200s. Yeah, I mean, that's one of the things that I think if I were to kind of, share some wisdom and share some sort of a thing that as you experience more and more things in the market, and one thing that if you want to take away from this live stream is that never be dismissive of anybody else's analysis, right? Anybody else's prediction or estimates or analysis. Like, however crazy as that might sound, in the realm of all possibilities, it's another possibility, right? So that's why I've always appreciated whatever you guys have to share in terms of analysis and research. It's a possibility, right? We have to take that into account. We have to consider it, and it's just another analysis. It could be crazy. It could be like just out of the wild, like insane prediction. But hey, it's always a possibility. So yeah, I think that's AMD stands for a massive oh, you guys are hilarious. Where is AMD trading right now? We're at 55.35, so down 4% right now. Yeah, pretty brutal drop here. $54 is my fair value, everybody. So I'm already going to be, I think, assigned. I had a $60 strike put. So that expires in December, but depends very much on the buyer, whether they exercise their right or not before the expiration. And if they do, my cost basis will be around $55, $56, because I think I'd receive like, actually it was a little bit higher. Might have been received like $500-$600 in premiums. So my cost basis will be at $54, $55. So yeah, it really depends on what the buyer ends up doing. If they exercise, I'll own AMD literally at these prices. If they don't, then I'll just simply hold that put. Dude says we laughed at Caddy Tesla 200. Now 149 seems likely. Yeah, very much. I think the valuation is definitely gonna come down. Yeah, AMD coming down to $54 range. Absolutely. Nima, I actually did a video on AMD. Again, $54 is the fair value that I have right now. But that's considering that we have 30% Q4 guidance. If 30%, if it's 20%, if it's lower, well, then that fair value is also going to be adjusted. But I'm assuming, at least on a more conservative case, that they do 30% guidance, at least 30% for Q4. All right. We got 15 minutes left. I'm actually really, really hungry right now. It's been what? We've been going at it for the last hour and a half. Or yeah, hour 15 minutes. So, oh man, I don't even know if I can have any food after this inflation print. So Hiren, actually been thinking about the Indian markets very much, because they've actually held up really well. You know, if you take a look at the Nifty 50, you know, it's not that much down from all-time highs from back in October of 21. It's only down 8.6%. So the Indian markets have actually done really well. And again, one of my family members and I were actually talking about this yesterday, that this is an emerging market that, you know, over the course of, let's say, next 3, 5, 10 years out, there is a possibility that Indian markets actually do outperform. But the only problem here is that it's not dollar denominated, right? You need to find a fund that's dollar denominated investing in Indian stocks. Because the reason is, well, if you invest in the Indian stock market in rupees, and then let's say 5 years, 10 years out, you make a return of, let's say, 10% annualized, but the dollar appreciates against the rupee 4 or 5% per year, then your real returns on a foreign exchange basis are going to be much lower. So again, I'm trying to figure something out, and I will share this with all the members and everybody in YouTube. I'll kind of share that. But there is opportunity, in my opinion, in emerging markets, especially India. So we'll figure something out. I don't want to have something that's very expensive, like in other words, high expense ratios or anything like that. A very, very low cost way of investing in the Indian markets through a dollar denominated fund. So that is kind of like the plan, and I will be sharing that with everybody soon. Yeah, so you could buy currency hedged ETF. That's the plan with TrueView. That's what we're really looking for, is to find a currency hedged ETF where we're not necessarily converting dollars to rupees to invest in the Indian stock market and then taking that currency hit. So that's what we're going to be planning to do. Yeah, if Apple goes to India, Nifty will go wild. That's true. I think Apple has really been shifting a little bit more towards India for manufacturing as opposed to China. So I think that would be a big move for, of course, the Indian manufacturing sector. And that would obviously create many jobs. That will create more productivity, more growth in that sector. So I fully agree. I think that would be very much significant for India. Sarb says, spend profits in India during visit, don't convert to USD. So Sarb, yes, I think that's a great point. That applies to like people that are living and living in India, but that doesn't apply to everybody, right? So I want to figure out a way where people everywhere can actually take advantage of that. So you're right, it does benefit people. If your goal is to actually live and spend in that country, it makes sense why you want to be invested in that currency. But if your goal is to not live or spend your money in that country, but simply take advantage of the profitability, well, you want to make sure that you are reducing that currency risk as much as possible. So that's why, like, obviously I don't want to be too selfish and be like, hey guys, I'm investing in Indian markets. I'm looking for like a more mass option available. So I'll share that with everybody so everyone can take advantage of that. So Realty Income Corp, yes, I do think it's come down very much, 56.65 right now. It's been selling off quite a bit. This was one of the outperformers in 2022. I think it still is. Year to date, it's down about 19, almost 20%, whereas the Nasdaq's down 35, S&P's down over, I think, 30. So this is I do think that's very oversold. I love their portfolio of companies that they have like in their rentals. So a next support really is going to be down to like this right here, $50 per share. But I really do like Realty Income Corp. Like even at these prices, I'd love to dollar cost average here. Don't you think the dollar is peak relative to other currencies, Ro? So yes, I think you bring up a great point. And this is also something that we were talking about, that look, even if we do take that currency risk, what if the dollar starts depreciating against some of the other currencies and we not only get the benefit of investing in foreign markets by generating that profitability, but also we get that tailwind of the dollar depreciating against, let's say, Indian rupees or the euro or the pound. So that's kind of like a double win, right? If you think about it. So that's something that we're just kind of like thinking about these things, and we're going to start brainstorming some ideas, some funds, and I'll share my analysis with those, with all the members as well. So. CTR says your circuit breaker is coming. Yeah, that'd be crazy. Dave says, Scotty, you have so much more energy in the States. Stay here. Yeah, I mean, I'd love to. So Brian, I do think that, on days like today, it's very difficult to find any buyers, considering that we also just flipped completely from, Fed funds futures standpoint. I mean, we literally just went from, look at that. Look at what's going on right now on the Fed funds futures. We're also seeing a probability shift towards 1%. So right now just a few minutes ago, we were at 95% for 75. And now we're sitting at over 8.2% for 1 percentage point and 91% for 75. So the markets pretty much have priced in 75 is done. And now what's next, right? Whether we get 1% or whether we get 75 and then 50 in December. I think if inflation remains hot, then there's a possibility that we get 75 for just the next 2 months, November and December. And that obviously would be crazy. Yeah, I mean, we're definitely going to extreme levels, SJ. I fully agree. I think we're definitely overshooting a little bit on the downside, and we're still not even priced in for earnings. That's the wild part. That's what's actually a little bit troubling for me personally, is that none of this is pricing in an earnings revision. Like, how are earnings estimates still high? That's my question. Like, if anybody can answer me that, I would really appreciate it. But how are earnings still not adjusted? Like, it's crazy. Analysts are like, what, waiting for the entire year to go by before they start making those adjustments? Like, so earnings will start getting released. Well, this week we have JP Morgan, BlackRock, Citigroup, all these companies reporting, and then of course next week we've got companies like Tesla, Netflix, and the big techs also going to be reporting later this month. Yeah, Walgreens, InMode actually reported some very good numbers, so that's good. Walgreens is down 1.2%. Looks like they beat on both earnings and revenue. So that kind of held up really well. That's good. And again, as I've said, I think the third quarter earnings will still be good. Q4 will start to really show some deterioration. And Q1 23 is what I'm really kind of, concerned about. Because going into the first quarter 23, we will pretty much have interest rates at 4.5%. And there will be a lot of things, a lot of headwinds in the first quarter 23 with respect to recession. So I think Q3 earnings still hold up somewhat good, considering that interest rates were not that higher. But Q4 is going to start to really deteriorate, and it's the first quarter 23 is when. Good luck. RD Greaves, so mostly invested about 16 to 18% cash right now. We'll be looking to kind of raise that up to 20, 25, possibly even 30%. As I trim some of my options or trim some of my profitable positions, just kind of get rid of some of the smaller losses. Really, the idea would be to consolidate into some of my highest conviction picks, and really trim the fat. That's the goal here as the markets are coming down. So, and of course, be ready for what 2023 might look like. The next 3 to 6 months is what I've mentioned as being the window of opportunity for all of us. Meta is about to hit a 1-digit PE. Yeah, I know. It's absolutely crazy. It's down another 3.6%, 122. So trading below its 2018, 2019 low. And Meta, I think, is down over 67% now. But that's the thing. Like if you take a look at any stock right now, it's not just about Meta or Netflix or PayPal anymore, is it? It's not about those companies. Like, yeah, sure, Meta's down 68%. PayPal's down 74%. Netflix is down 69%. But then you also look at Nvidia, right? Nvidia's down over 68%. So Nvidia's down the same amount as Meta, and yet Nvidia has a higher P multiple. AMD, right? AMD is down over 66%. Tesla is down over 49, almost 50%. So Tesla's also been cut in half. Microsoft down over 37%. Google held up a little bit better, of course, but still down over 37%. So, it's not just about those companies. I mean, every single player in big tech has just been getting destroyed on a year-to-date basis, on an all-time high basis. So, Apple, one and only, just holding up. Well, it's also down, I think, 20%, at least 25%, 26%. There we go. It's also down 26%. So, yeah, Apple was kind of like a lone survivor up until it was like, you know what? I can't do this on my own. Screw it. I'm going down too. And InMode is the only one that's positive because of very good guidance. So David, do I believe in the metaverse? So again, I think metaverse has gotten a very sort of negative connotation to what it actually means. I believe a lot of it has to do with the use case. The utility of the metaverse is like insane. Just the things that you can actually do with virtual reality are going to be significant. It's not a surprise that pretty much all the big players are going into the metaverse. Like there's opportunity there. And we're not just talking about, I know when people talk about the metaverse, oh, I want the reality. I love the reality. I want to be out and about. I want to be in a virtual world. Sure, I agree. And I want to be the same way. I want to actually experience things in reality and not be sucked into this virtual world. But I'm talking more in terms of utility, the use cases which companies can use to pretty much build prototypes, test out, do experimentation for education, manufacturing, architecture, chemistry. Like there's so many different things that the metaverse can be used in from a utility standpoint. Utility and entertainment when it comes to gaming. I know there's going to be a big boom for metaverse in the gaming side of things. So those are the two places where I think there's a pretty significant use case. I'm not talking about people spending time in VR 24/7, but businesses using the technology to benefit themselves and, of course, save time, resources, and money. So that is what I think about. So yeah, Sordy, thank you so much for joining. I really appreciate it. Hope you have a great day. And yeah, Oya says metaverse is still way too early. It'll be huge. I agree. I think there's the use case is incredible. I think the utility for that is amazing. It just needs to be adopted really well, and of course the technology needs to be very high. So yes, Rose says enterprise value for AR VR is the moneymaker. Correct. I fully agree. And you watch any Oculus videos, right? I've pretty much spent a lot of time watching Oculus and the things that you can do. You read the comments. That's all I'm going to ask from you, is that you go watch any Oculus video and you read the comments. Man, people literally just love that thing. I've never used it. I've never bought it. I'm sure we've got some people that have Oculus. But the comments are incredible. Like, people just love the Oculus and the things that you can actually do with that. And think about it, like, we're still in the early stages of that. So next support for the Qs, let's take a look. So we're definitely starting to break down. Of course, on the weekly time frame, we're below the 200 SMA. We're below the moving averages, below this significant support here as well. The next real support really is going to be 230. That's going to be the more important level here. That's in line with that pre-pandemic high, so pre-pandemic resistance, and the 300 SMA on the weekly chart at 230. So 230 is what I'm really watching. By the way, the market is just open, man. When you start having fun, you pretty much forget that time's flying. I know, right? So Dow Jones opening down 1.6%. We got the Nasdaq here opening down, probably going to be just over 10,000. So we're just at 10,100 right now. So we're all the way down here, and the S&P here down about 2% as well. The yield is pushing through to a new 52-week high at just under 4.1%. And then when we take a look at individual stocks here, Nvidia is down to 109. Tesla is down to 209, and we got AMD down to $55 per share. Apple's also down about 2.5%. So yeah, this thing, the markets in 2022 has been a lesson and a half. So Amazon down 4.5%, almost 5% actually. Nvidia down 4.5%, AMD is down 4%, Tesla's down 4%, Netflix is down 3%, Microsoft is down 2.5%, Google is down 2.5%, Meta is down 2.3%, Apple's down 2.5%. So yeah, pretty much the entire watch list is red except for InMode. InMode is higher, but only up by 4.5%, almost 5% after reporting some very good preliminary numbers, and Walgreens is up 0.7%. But everything else is, entire watch list is red. Down, down, and down. Tesla finally going to reach your target, and so many people were saying that I was lunatic. No, it's all good. I understand. Again, everybody's got different perspective and opinions, and that's what we're here to kind of hear them out and respect. And that's what makes the market, right? If you think about it logically, right? If you're selling, someone else is buying. If you're buying, someone else is selling, right? Everybody has a different opinion on the market, and that's really what makes the market. So for me, it's never been about, look, I told you, or like I was right or anything. It's just kind of sharing the best possible analysis as I can, and like just sharing high quality content. And of course, there's going to be disagreements, but then if there are, I'm curious to learn about, look, what is your perspective, right? What is your analysis? And just having that open mind to understand different opinions and different perspectives. So it's never really about, right or wrong. It's just about understanding different perspectives. So over 80 notifications. Yeah, that's what it is. I mean, lots of stocks just kind of breaking down. Technicals really looking weak. Sonker says, Kat, you saved me a lots of money. Thanks for all the patience lessons and your wonderful analysis on helping understanding the market in general. Thank you. I really appreciate that. And glad you were able to save a lot of money with the analysis here. So Nasdaq just over 10,088. So, it kind of feels like it's going to break down below 10,000 today. I think very close. But the thing is, the volatility is really subdued. Really, really subdued. It's just not really pushing through. You know, one guess is that there's mostly like selling pressure coming through. Like people are selling, but they're not necessarily buying put options. Because if you think about it, volatility really gives us the implied move on the S&P 500, of course, and what the put options, call options are doing, right? What options chain is actually doing. So it's kind of like a fear index for us to better understand what the S&P might do on an implied basis moving forward. So if the VIX is very subdued, if it's not really moving that much, my guess is there's not a lot of options activity on the market, but instead just straight up selling. And this week, I mean, the Nasdaq's down 5% already. Yes, Fortinet definitely is coming down quite a bit. So Fortinet is also another stock that I'm paying attention to. It's got a brutal week. It's down over 10.8%. So yes, we're going to be paying attention to this. The lower it gets, the better I think the pricing will become for Fortinet as well. Nasdaq next support really is going to be 9,800, 9,750 to 9,800. So that's what we're watching for the Nasdaq, and for the S&P 500, we're looking at, well, we're at 3,500. There we go. We're just breached 3,500. We came down to 3,491. So, you know, this is the fib level that we talked about, 0.5 or 50% retracement level on the S&P. So 3,500 is what we were watching. AMD under $55, down 5%. Apple down 2%. Nvidia is down 5.3%, and Tesla is down over 4% as well. Upstart 8.7, Coinbase down 9.7. Yeah, InMode and Walgreens are the only two stocks that are pushing higher. Walgreens, I think, actually did really well with their earnings. So, and the 10-year yields, of course, are at over 4.04%, and the dollar index back up to 113.6. Conrad, thank you so much. I really appreciate that. You said thank you for your video. These are the best quality stock market videos out there. So I just bought your course bundle to learn more. Yeah, I mean, in that bundle, you will find over 80 plus video lectures. You will get everything, literally everything you need to learn about fundamental analysis and technical analysis. Both of those disciplines are covered, and you can combine both of those strategies to, of course, apply them in the real world. You go over valuation analysis, sensitivity grids, fair value models, and of course, on the technical side, you learn about different strategies, divergences, crossovers, technical indicators. There's a lot of value kind of packed in that. So I really appreciate it, and let me know what you think. You'll definitely find a lot of value in those courses. Yes, Amazon's going to hit your target very soon. So yeah, definitely coming down to $100. Very, very interesting level for Amazon. We still have some ways to go, but it's down 6% now, under $106. And yeah, coming down to closer to $100. So that would be the fair value there. Diamond pattern on SPY. Yes, I did check that out, Ranjit. I'm gonna switch over to Discord here very soon, and then we'll take a look at that together. But yeah, there's gonna be a lot of interesting analysis and technicals to look for the markets. Let's take a look at energy. So BP and Shell are the only ones that are pushing higher. Crude oil is now under $87. So again, we're starting to see a little bit of a pullback on crude oil. But there's the thing, like October crude oil prices are higher. We want this back in the negative territory if we are going to see something lower. So what's equivalent of Bank Nifty in the US? I would say it's XLF. So if you take a look at XLF, it's the financial sector index on the S&P 500. So I can actually see something very similar, or VFH. That's also the Vanguard's financials ETF. So these are both like tracking banks and financials in the US. Yeah, Ranjit, make sure that you share your chart with the pattern, and we'll take a look at that together after the live stream here. So David, you can actually look at selling covered calls. You don't have to necessarily feel powerless. If you do have a portfolio of stocks, even if you don't have any money to kind of dollar cost average, sell covered calls. That's literally just if you're in a situation where you're holding a stock portfolio where you have no more cash to dollar cost average, right? Obviously, it's not the best scenario to be in. Sell covered calls. You can generate passive income literally every month, and chances are with the market the way it is, most contracts are going to expire out of the money, worthless. Right? So look at shares that you have 100 shares, look at a stock that you have 100 shares of. Sell, you can even sell like a near the money or a little bit further out of the money call, and with the markets as much as they're selling off, chances are it's going to be expired worthless, and you get to keep the entire premium. And you do that over and over again until you kind of build up a cash position that you can start dollar cost averaging again. What that does is not only does that lower your cost basis for the existing stock position, but it also generates buying power, right? It also generates buying power so you can actually go out and start buying more stocks. So you don't have to necessarily feel powerless, man. David, I totally get it, man. It's definitely one of the worst markets to be in, but that's an option available for you. Ankur, what do you think about allowing your brokerage to do securities lending in your portfolio? You know, it's a debatable topic, really. I mean, if you're against all the short selling, if you are against hedge funds kind of shorting stocks, sometimes even doing synthetic shorting and all those different things, then you can turn that off. But if you want to generate some passive income, and because they pay you the interest on that, right? So whatever interest they earn from lending your shares, they give you, I think, a portion of that. If you want to generate passive income, then sure, you can turn that on. So it really depends on your perspective. And it can also be on specific stocks too, right? I mean, if you're looking at big tech, who cares, right? If their short interest goes from 1% to 3%, not a big deal. So I can personally just leave that turned off. They can lend those shares and pay me the interest. But if it's something like, an AMC, not that I would own AMC, but if it was something like a stock that was heavily shorted, and it was more of an ethical reason that I didn't want more hedge funds to short that stock, then I would just turn that off and not allow them to lend that shares out. So it's more of a debate. It really depends on your personal preference and what stock you're dealing with. Breezy, yes, we do have tutorials in our Patreon. So if you come over to our Discord, you should see the private videos channel over here. So private videos right over here. And these are all tutorials I post for all of our members. And I'm going to start doing more and more of these, like more private updates and more ad-free content for all the members moving forward. But this is all the options tutorials. So you can literally just check them out. The first strategy is catch good puts, covered calls, leaps, protective collars, and then iron condors and some more that we're going to continue to kind of do moving forward. There's also fundamental analysis tutorials. And this is separate from the course itself. This is more on a monthly basis that I share tutorials and different educational stuff for all the members. So that's available if you want to take advantage of that. And of course, link's going to be down below. So, all right, so that's where we are. You probably heard my stomach also growling right now because I'm so hungry right now. I hadn't had any breakfast. Yeah, when do you review the secret guest? Still kind of reaching out to them. They've been really busy. So I've just been kind of working out a time, day and time. So hopefully we'll get it done in October. If we don't, then we'll just have to push it back to a different month. So, all right, everyone. So that's going to be it. I'm going to spend some time in our Discord, kind of share some updates over there as well, share some alerts. So thank you so much for joining in. I really appreciate it. And as always, if you guys enjoy this live stream, if you enjoy this video, make sure that you drop a like and, of course, subscribe. Subscribe to the channel. We've got, very solid, down-to-earth, grounded community if you want to be a part of our money investing channel and, of course, our community. And, of course, the link's going to be down below if you want to join our Discord. We've got over 3,500 members there. And again, all the updates, analysis are shared over here. These are all the private videos that you get access to. This is ad-free content. And of course, all the trading view alerts, our Google spreadsheets are also available. So you can access monthly calendars, S&P 500 price earnings multiple, inflation trackers, fair values, all that stuff, ask me questions, and of course, engage with other members as well. So links down below. As always, happy investing. And I know the print was not great, but I'll be sharing some thoughts and opinions later today as well. So as always, happy investing, and I'll see you guys in the next video.